Hello everyone. Welcome to the TradeAbility channel. In this video we're going to talk about Fibonacci in trading and how you can use it to win more trades. Using Fibonacci is one of the best ways to time your entries and exits. The Fibonacci tool is used by professional traders to measure retracements and extensions of price movements. When paired with price action, the Fibonacci trading strategy can help you maximize your profits. By the end of this video, you will learn what Fibonacci is, how to use the Fibonacci retracement and extension tool, and learn how to trade Fibonacci with price action and provide you with real-world examples. But before we get started, if you find this video and channel to be useful, hit the like button, subscribe, and hit the notification bell so you'll always know when we release a new episode. What is Fibonacci? Fibonacci refers to a sequence of numbers in mathematics, where each number is the sum of the two preceding numbers. The sequence starts with 0 and 1, and goes on infinitely as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. The Fibonacci sequence has numerous interesting mathematical properties and is found in many natural phenomena, such as the growth patterns of plants, the arrangement of leaves on a stem, and the shape of shells and spirals. It is also used in various fields, including computer science, finance, and art. So what's the big deal about this sequence of numbers and what does it have to do with trading, you may ask? Well, what's most important are the ratios that this sequence of numbers produce. These ratios are what traders use as natural areas of potential turning points in a retracement. If you take the ratio of any two consecutive numbers, the ratio will be approximately 1.62. This is what is referred to as the golden ratio. Other significant ratios are 1.38, which is the ratio between every two numbers in the sequence, and 1.24, which is the ratio between every three numbers. Now we know what Fibonacci is, let's see how it's used in trading. How to use the Fibonacci tool. The first thing you must do when using Fibonacci tool is to identify swing highs or swing lows. A swing low is when price makes a low and is immediately followed by two consecutive higher lows. Likewise, a swing high is when price makes a high and is followed by two consecutive lower highs. We'll start with the example of this swing high. Here you can see price has created a new high, then immediately proceeded with two lower highs. Once you've identified the swing high, then you look for the next swing low, which is a low followed by two higher lows. In your trading platform, look for the Fibonacci tool. Then, using the cursor, select the swing high and drag the cursor down to the swing low. If it's your first time using the Fibonacci tool, you may need to adjust the settings. You'll need to experiment with the settings so you can make the Fibonacci lines visible to your liking. You'll also need to add the following levels: 0, 0.236, 0.382, 0.5, 0.618, 1, -0.382, and -0.618. Now that we have identified the levels, we can now analyze the chart. As we have identified previously, we have a swing high and a swing low. The price is now retracing after a strong downward move. We can see that the price hit the 61.8% retracement and then immediately resumes the downward trend. The perfect trade in this scenario is to identify that the price is reversing at the 61.8% level, and place a sell order. The stop loss can be placed at the 100% level, and your take profit levels will be the extension levels, which are -38.2% and -61.2%. These levels are the Fibonacci extension levels. The area in the red is known as the retracement levels. In this example, you would set two profit targets, one at each of the extension levels. You would close half the position at the first level, and then move your stop loss to break even and just let the trade play out. We can see that the price hit the first profit target at the 38.2% extension level and begins to move against the trend. So now we know the basics of Fibonacci, let's talk about some strategies. Because we don't know where the price is going to retrace, one strategy is to always place a sell or buy trigger order at the 61.8% and ignore all the other retracement levels. Set the stop at 100%. And then set the profit targets at the 38.2% and 6.8% extension levels. This strategy gives you an excellent risk-reward ratio of about 2.5 at the first profit target and 3 at the second profit target. This strategy is excellent if you can find a strong trending market, as the probability of prices to retrace and continue with the trend is higher. If you, However, prefer to have a more conservative approach and would like to see confirmation of reversals in the retracement zone, then I recommend using candlestick patterns. In this video we are not going to go into detail about candlestick patterns, but if you're interested, please check out our other videos in our channel. For Fibonacci reversals, I recommend the following candlestick patterns: the engulfing pattern and the pin bar pattern. There are lots more different patterns, but from my experience these are the two best patterns to trade with Fibonacci as they have the highest probability and frequency. Let's start with the engulfing pattern and show you some examples. In this first example, we have a downtrend. We've drawn the Fibonacci levels from the swing high to the swing low. At the 38% retracement level, an engulfing pattern forms and we place our entry at the open of the next candle. We set our stop loss at the 100% retracement and set our two take profits at the extension levels. This trade resulted in taking profit at both target levels, giving us a risk reward of 1-to-1. In this next example, we have an uptrend. A bullish engulfing pattern forms at the 50% retracement level. We buy at the open of the next candle and as always, we place a stop at the 100% retracement, and two take profits at the extension levels. This trade resulted in hitting both take profit targets, giving us a 1-to-1 risk reward. Let's do one more example using the engulfing pattern. Here's another downtrend. We see an engulfing pattern at the 38% retracement and we place a sell order at the open of the next candle. We set our stop loss and take profit levels as always. This trade resulted in another 1-to-1 risk reward. I think you're getting the hang of it. Let's move on to the pin bar pattern. Here's an example of a reversal with a pin bar pattern at the 61.8% retracement. This chart is not as clear-cut as the previous examples. Can you spot the swing low, swing high and the pin bar? Lots of retracement and reversal signals here. I'll give you a second to spot it. Here's the pin bar. We'll set a buy order at the start of the next candle, and set our stop loss and take profit levels. This trade resulted in slightly better risk reward of 1-to-1.5. Let's do one more pin bar example. This time a downtrend. Here's my swing high. Here's the swing low. The price retraces and I look for a reversal pattern. This pin bar is my signal. I take a sell on the open of the next candlestick. I set my stop loss and take profits as always. The price bounce off the two extension levels like magnets, resulting in another successful 1-to-1 trade. Let's go over what we've learned in this video. We've learned about the Fibonacci number sequence and how the ratios were derived. We've learned how to set up and draw Fibonacci lines on the charts using swing high and swing lows. We've learned how to analyze the chart with Fibonacci levels and identify the retracement and extension zones. We've learned two strategies. Let's quickly recap the two strategies we discussed. The first strategy is always setting a buy or sell limit order at the 61.8% retracement level. Ignoring all the other retracement levels. Put a stop at the 100% level and two take profit levels at the 38.2% and 61.8% extensions. The benefits of this strategy is that it provides an excellent risk-reward ratio. It is also an easy set and forget strategy, so you don't have to be constantly monitoring the chart waiting for a reversal. The second strategy is using candlestick patterns to spot reversals in the retracement zone and entering a buy or stop order at the start of the next candle. For this strategy we only focused on two main candlestick patterns: the engulfing pattern and the pin bar. The benefits of this strategy is that it offers a higher probability entry, but the downside is that it requires you to watch the market carefully. The risk-reward ratio for this strategy is not as good as the first strategy, but the higher probability of success makes up for it. Well, there you have it. If you enjoyed this video and found it useful, please like and subscribe, so we can provide you with more trading videos to help become profitable in trading. See you in the next video.